2008 Virginia, a year that would go down in financial history as one of the most devastating for the Old Dominion state. But nestled amongst the ruins of a crumbling economy, a scandal was brewing that would expose the biggest financial crime the state had ever seen. This is the story of how a man named Fred Loss, once hailed as a successful and respected businessman, orchestrated an intricate web of deceit, manipulation, and outright theft in what has come to be known as one of the most notorious Ponzi schemes of our time. A Ponzi scheme, for those unfamiliar with the term, is a fraudulent investing scam promising high rates of return with little risk to investors. The returns are paid out from their own money or money paid by subsequent investors, rather than from any actual profit earned. Named after Charles Ponzi, who became notorious for using this technique in the 1920s, these schemes rely on a constant flow of new investors to provide the funds needed to pay earlier investors. In Fred Loss's case, he promised his unsuspecting victims returns as high as 18% per month. And for a while, it seemed like he was delivering on those promises. But what his investors didn't know was that Loss was using their money not to generate actual profits, but to fund his lavish lifestyle and pay off earlier investors. As we delve deeper into the story of Fred Loss and his Ponzi scheme, we'll explore the factors that allowed this massive fraud to go undetected for so long, the impact it had on the lives of those who lost everything, and the lessons we can learn from this cautionary tale. Along the way, we'll also meet the investigators, lawyers, and victims who fought to bring Loss to justice and seek redress for his many victims. But before we dive into the details of the case, let's take a moment to understand just how big this scheme really was. At its height, it's estimated that Loss had defrauded over 4,000 investors out of more than 70 million. The sheer scale of the crime is staggering, and it serves as a sobering reminder of the dangers posed by unscrupulous financial operators. So, join us on this journey down the money trail as we explore one of the most infamous Ponzi schemes in Virginia history and expose the man behind the curtain, Fred Loss. In the world of high finance, few figures have captured the public's imagination quite like Fred Loss. A self-made man who rose from humble beginnings to become one of Virginia's most successful financial operators, Loss seemed destined for greatness from an early age. Born in a small town in rural Virginia, Loss showed an aptitude for numbers and a keen business sense from a young age. After graduating at the top of his class from the University of Virginia's prestigious McIntire School of Commerce, Loss quickly climbed the ranks of several major financial institutions. By the early 2000s, Loss had established himself as a rising star in a world of finance. He founded his own firm, Loss Financial Group, which quickly gained a reputation for its impressive returns and innovative investment strategies. But beneath the surface, all was not well. In reality, Loss was running one of the largest Ponzi schemes in Virginia history. For years, he had been using money from new investors to pay off earlier backers, creating the illusion of massive returns on their investments. The scheme continued to grow, fueled by Loss's charm and charisma, as well as his seemingly unbeatable track record. But eventually, the house of cards came crashing down. In 2018, federal investigators descended upon Loss Financial Group, seizing records and questioning employees. It was soon revealed that Loss had defrauded over 4,000 investors out of more than 70 million. The sheer scale of the crime is staggering, and it serves as a sobering reminder of the dangers posed by unscrupulous financial operators. Today, Fred Loss sits behind bars, serving a lengthy prison sentence for his crimes. But the legacy of his fraud lingers on, a cautionary tale for investors and financial professionals alike. As we follow the money trail, we'll explore how Loss was able to pull off such an audacious scheme, and what lessons we can learn from his downfall. The biggest financial crime in Virginia history was committed by none other than Fred Loss, a man who once commanded respect and trust in the financial world. But behind closed doors, he wove an intricate web of deceit that would eventually lead to his downfall. At the heart of Loss's fraudulent scheme were two investment strategies that he marketed to unsuspecting clients: the market-neutral strategy and the fixed-income arbitrage strategy. Both sounded impressive and sophisticated, designed to appeal to investors seeking high returns with minimal risk. However, Loss's strategies were nothing more than a mirage. The market-neutral strategy was supposed to involve buying and selling stocks in equal amounts, effectively hedging against market volatility. But in reality, Loss was simply pocketing the money and using it to fund his lavish lifestyle. Meanwhile, the fixed-income arbitrage strategy involved exploiting discrepancies between different bond prices. Again, Loss promised his clients impressive returns with little risk. However, he had no intention of executing these trades. Instead, he used the money to pay off earlier investors, creating the illusion of a profitable investment strategy. Loss's scheme began to unravel in 2015 when the Securities and Exchange Commission launched an investigation into his activities. They discovered that Loss had been running a classic Ponzi scheme, using money from new investors to pay off earlier ones. In total, Loss defrauded his clients of over $7 million. The scale of Loss's fraud is staggering, but what's even more shocking is how long he was able to get away with it. For years, Loss presented himself as a respected financial professional, earning the trust of his clients and colleagues alike. But beneath the surface, he was nothing more than a con artist, willing to exploit anyone who crossed his path. As we follow the money trail, we'll continue to explore the tactics used by fraudsters like Loss and what can be done to protect ourselves from their deception. The story of Fred Loss is a cautionary tale for us all, reminding us that in the world of finance, nothing is ever quite as it seems. The victims of Fred Loss's schemes were ordinary people, trusting souls who had worked hard to save for their future. People like Eleanor Harbour, a retired schoolteacher from Norfolk. Eleanor met Loss at her church, where he was volunteering as a financial advisor. He seemed kind and knowledgeable, and Eleanor felt comfortable enough to share her life savings with him. Over the course of several years, Loss convinced Eleanor to invest in various schemes that he promised would bring her great returns. But instead, Eleanor lost everything. By the time the authorities caught up with Loss, her retirement fund had been completely wiped out. Then there's the story of Robert and Susan Thompson, a couple from Richmond who had been saving for their daughter's college education. They met Loss at a community event where he was giving a talk on investment strategies. Like Eleanor, they were impressed by his credentials and seemed like a trustworthy individual. Over the course of several meetings, Loss convinced them to invest in a risky real estate venture that he claimed would yield high returns. But the project never materialized, and the Thompsons lost their entire college fund. These are just a few examples of the human toll wrought by Fred Loss's financial crimes. In total, he defrauded over 50 victims out of more than 7 million. The impact on their lives has been devastating. Many have had to delay retirement or sell their homes to make ends meet. Others have suffered from stress-related health problems as a result of the financial strain. The story of Fred Loss is a painful reminder of the fact that financial crimes can have real and lasting consequences for ordinary people. As we follow the money trail, we'll explore the tactics used by fraudsters like Loss and what can be done to protect ourselves from their deception. But we must never forget the human cost of these crimes, the shattered dreams and broken lives that result when greed and deceit go unchecked. In the aftermath of the unraveling financial scandal, the focus shifted to the official response, the investigation, arrest, and trial of the perpetrator. The man at the center of the storm was Jeffrey Carpenter, a seemingly successful businessman who had built a career on trust and integrity. However, beneath that veneer lurked a web of deceit and fraudulence that would eventually lead to his downfall. The investigation into Carpenter's activities began in earnest when several of his investors filed complaints with the Virginia Bureau of Financial Institutions. These investors claimed that Carpenter had misappropriated their funds, using them for personal expenses rather than investing as promised. The Bureau launched a thorough examination of Carpenter's business dealings, uncovering a tangled web of financial transactions that stretched back years. As the investigation progressed, it became clear that Carpenter had orchestrated an intricate Ponzi scheme, siphoning millions of dollars from unsuspecting investors and using the money to fund his lavish lifestyle. The scale of the fraud was staggering. Over a period of 5 years, Carpenter had defrauded more than 150 victims out of nearly 20 million. In June 2019, the authorities arrested Carpenter and charged him with multiple counts of fraud. His trial, which began in early 2021, was a closely watched event, as it offered a rare glimpse into the inner workings of a major financial crime. Prosecutors presented evidence detailing Carpenter's elaborate scheme, painting a picture of a man who had knowingly and deliberately deceived those who had trusted him. In March 2021, after a lengthy deliberation, the jury returned a guilty verdict on all counts. Carpenter was sentenced to 30 years in prison and ordered to pay more than $19 million in restitution to his victims. The judge's ruling served as a stark reminder of the consequences of financial crime, emphasizing that such actions have real and lasting consequences for ordinary people. As we continue to follow the money trail, it is essential to remember that behind every statistic and dollar amount lies a story of shattered dreams and broken lives. The Jeffrey Carpenter case is a cautionary tale, one that highlights the importance of vigilance and skepticism in today's complex financial landscape. As we pick up the pieces of the Jeffrey Carpenter Ponzi scheme, it's crucial to examine the aftermath, the attempts to recover losses, support victims, and heal the community. The sheer scale of this financial crime is staggering, $68 million stolen from over 400 unsuspecting Virginians. The Virginia State Corporation Commission's Bureau of Financial Institutions stepped in, issuing a cease and desist order against Carpenter and his company, Covenant Capital Management. Simultaneously, the Federal Bureau of Investigation began a criminal probe into what would soon be revealed as one of the biggest financial crimes in Virginia history. In June 2013, Carpenter was arrested and charged with mail fraud, wire fraud, and money laundering, charges that could potentially land him behind bars for up to 220 years. Meanwhile, the United States Securities and Exchange Commission filed civil charges against Carpenter and his firm, seeking injunctions, disgorgement of ill-gotten gains, and monetary penalties. But what about those who lost their life savings? Many victims were elderly or nearing retirement, individuals who had trusted Carpenter with their hard-earned nest eggs. The SEC established a fair fund to return ill-gotten gains to harmed investors, yet the road to recovery is long and arduous. By April 2016, only 19 million had been recovered and distributed among approximately 250 victims, a fraction of the total losses incurred. To help these individuals navigate the complex legal process and access available resources, organizations like the National Association of Securities Dealers Arbitration Forum and the Financial Industry Regulatory Authority offered pro bono mediation services and educational workshops on investor protection. In the aftermath of such a devastating financial crime, communities must come together to heal and rebuild trust. This means fostering open dialogue about personal finance, encouraging skepticism when presented with lucrative investment opportunities, and advocating for stricter regulations to protect vulnerable populations from predatory schemes. As we follow the money trail, let us remember that behind every statistic and dollar amount lies a story of shattered dreams and broken lives, ordinary people who have paid the price for one man's greed. And while justice may be served through lengthy prison sentences and hefty fines, it is only through collective vigilance and education that we can truly prevent similar crimes from happening in the future. In our investigation of the biggest financial crime in Virginia history, we've exposed a tangled web of deceit that has left countless lives shattered. But as we follow the money trail, it becomes clear that this tragedy was not only made possible by one man's greed, it was also facilitated by gaping loopholes in our financial regulatory system. At the heart of the scandal is John A. Haywood, a former executive at Star Scientific, who orchestrated an elaborate pump-and-dump scheme that defrauded investors out of millions. Between 2006 and 2011, Haywood and his associates artificially inflated the company's stock price through false statements and misleading reports, only to sell off their shares at peak value and leave innocent investors holding the bag when the bubble burst. Yet despite numerous red flags and warnings from whistleblowers, regulatory agencies like the Securities and Exchange Commission and the Financial Industry Regulatory Authority failed to intervene in a timely manner. In fact, an SEC examination of Star Scientific in 2010 raised concerns about the company's financial reporting practices, but no action was taken until it was too late. One reason for these regulatory failures is the revolving door between government agencies and the industries they are supposed to oversee. For example, Robert Khuzami, who led the SEC's enforcement division during this period, had previously worked as a lawyer for Davis Polk & Wardwell, a firm that represented Star Scientific in its dealings with the agency. Moreover, the complex nature of modern financial crimes often outpaces the ability of regulators to keep up. As we've seen with Haywood's scheme, sophisticated fraudsters can exploit gaps in oversight by operating across multiple jurisdictions and product lines, making it difficult for any single agency to detect and prosecute their activities. So what can be done to prevent similar crimes from happening in the future? It starts with increasing transparency and accountability within our regulatory system. This means closing loopholes that allow bad actors to slip through the cracks, strengthening penalties for financial fraud, and ensuring that those who break the law are held fully responsible for their actions. But ultimately, it also requires a collective commitment to vigilance and education, not only among regulators and law enforcement officials, but also among investors, consumers, and ordinary citizens. By shining a light on the dark corners of our financial system, we can begin to build a more just and equitable society for all. 300 lives were changed forever on that fateful day in 2.